John Higgins, Mortgage One. Happy Monday. So, Friday of last week, we did get the non-farm payroll numbers out, and quite disappointing. The street was expecting a number well above the 22,000 that was actually reported. If you look at this graph over the last 6 or 7 months, you can see the jobs market or the employment numbers are really running out of steam here. And it really has sealed the deal for a Fed rate cut coming up here in a couple of weeks in September. If we look at what the market is projecting, well, we call this being fully priced in as far as a cut. 90% chance that we get 25 basis points, and 50 basis points now is poking its head above 10% as far as a chance. So when we do hear from the Fed, we'll get an indication how much they're going to cut, obviously, and then if there's any follow-up rate cuts that are coming. The market is certainly cheering on this bad jobs number. And we've talked about this band between 420 and 450 on the 10-year Treasury. We've finally broken beneath that quite nicely. We're going to close a couple days well below that. So we're approaching 4% on the 10-year Treasury, and we've not really seen that since April earlier this year. And if you look at the graph on the 10-year Treasury, we did hit something close to 4% and absolutely spiked back up above 450 within a week or two. So, interest rates are volatile these days. There's a lot of market anxiety out there between tariffs, inflation, what the jobs numbers are doing. And you can see there's been a battle here, but we've finally broken below 420, and that's great news if we want lower interest rates. Freddie Mac survey that came out last week on Thursday before the jobs number showed us down to 6.5%. I will tell you that mortgage interest rates now are breaking closer to 6% if your client has a decent down payment and good credit. So that's great news for home affordability. And as we get closer to maybe a 5 handle on interest rates, might actually drive a few sellers out into the market. So that would certainly help the inventory levels that we've been fighting here in the Midwest and certainly in Michigan. I wanted to let you know about a number of different first-time homebuyer options. As interest rates come down, we expect to see more renters start thinking about buying. So not only do we have some of our government-insured products out there, so your FHA, VA, and rural development that offer nice low-down payment options, Fannie Mae and Freddie Mac also have some first-time homebuyer programs that offer lower down payments with lower interest rates and mortgage insurance premiums. Fannie Mae also offers a homebuyer grant of up to $2,500 for your borrowers that have less than 50% of the average median income. That's AMI. Everybody should know about MSHDA and the $10,000. It's available statewide. There are some restrictions on that. You have to have a credit score above 640. There are some income limits, and the sales price limit has been increased this year to over $544,000. So that opens a lot more homes for buyers to look at. There are a number of area-specific down payment assistance programs. So many counties around the state and some cities do offer down payment assistance. Some of them are quite generous, and some of them are actually forgivable, unlike MSHDA that requires a repayment of that down payment assistance when the property is sold. So we can sometimes stack some of these down payment options. So if you have a buyer that qualifies pretty much across the board but just hasn't been able to save for the down payment, I always say down payment, shockingly, is the least important item that a buyer needs to bring to the table. We might be able to use these down payment assistance programs in conjunction with maybe seller concessions to get that buyer out of a rental and into a home. We'll talk to you next week. Until then, have a great day.